While putting money in a bank offers various benefits such as security, interest earnings, and convenient access, there are also potential disadvantages to consider. That's what I'll be talking about in this video. Hello, welcome back to my channel. If you're new here, make sure to hit that subscribe button and the notification bell so you don't miss out on any of our future videos. We release new content regularly, covering topics like personal finance, money management, and economics. Alright then, let's jump right into today's video. Without wasting any time, let's get to it. Here are the disadvantages that come from letting your money sleep in the bank. First off, many banks offer really low interest rates. Banks typically offer relatively low interest rates on savings accounts, which might not keep pace with inflation. This means that the real value of your money could decrease over time. You need to understand that banks are not there to make you rich by default. They are there to offer you a service and make money for themselves in the process. Personally, my savings account is just for an emergency. I've saved for a whole year's worth of expenses as a cushion for unforeseen problems. In this account, I don't really care about the interest is just a bonus. Once I had saved for a whole year worth of expenses, I could now focus on investing. The next thing that discourages me from banks is the fees. Some banks impose fees for various services, such as account maintenance, overdrafts, wire transfers, and more. These fees can eat into your savings if you're not careful. When you put your money in the bank, you run the risk of inflation. Inflation can erode the purchasing power of your money over time. If the interest rate on your savings account is lower than the inflation rate, your savings might lose value in real terms. Opportunity cost. The money you keep in a savings account might be missing out on potentially higher returns from other investment options like stocks, bonds, or real estate. And that's why my money is now divided between expenses and investments. My money never sleeps in the bank, except for a small portion that's there for savings. Liquidity limitations. While banks offer easy access to your funds, there might be limitations on withdrawing large sums or making frequent withdrawals without incurring penalties or fees. Security concerns. While bank deposits are often insured up to a certain limit by government programs, there is still a very slight risk of bank failure. This could potentially lead to loss of funds if the amount exceeds the insured limit. Emotional factors. Having a substantial amount of money in a bank might give you a false sense of financial security, potentially discouraging you from exploring more diverse and potentially profitable financial strategies. Privacy concerns. Depending on the jurisdiction, banks might be required to share certain account information with authorities, potentially compromising your financial privacy. Dependence on banking system. Placing all your funds in a bank makes you reliant on the stability of the banking system. Economic downturns, banking crises, or other systemic issues could impact your ability to access your money. Account access issues. Banks might have occasional technical glitches, maintenance, or security concerns that could temporarily disrupt your access to your funds. Currency fluctuations. If you have funds in a foreign bank account or in a foreign currency, fluctuations in exchange rates can affect the value of your money when converted back to your local currency. Missed investment opportunities. If you keep too much money in a low-interest savings account, you might miss out on chances to invest in your education, business ventures, or other opportunities that could potentially yield higher returns. That said, there are several alternatives to putting money in traditional banks. The choice of alternative will depend on your financial goals, risk tolerance, and the level of control you want over your funds. Here are some alternatives to consider. Alternative number 1, we have high-yield savings accounts. Online banks and financial institutions often offer higher interest rates on savings accounts compared to traditional brick-and-mortar banks. This can help counter the issue of low interest rates. Number 2, we have certificates of deposit, CDs. CDs are time-bound deposits that offer higher interest rates compared to regular savings accounts. They require you to leave your money untouched for a specific period, which could range from a few months to several years. Number 3, credit unions. Credit unions are similar to banks but are often member-owned and operated, which can lead to better interest rates and lower fees. They offer similar services to banks, including savings accounts, loans, and more. Number 4, we have money market accounts. Money market accounts combine features of savings and checking accounts, offering higher interest rates than regular savings accounts. They may come with some limitations on withdrawals. Number 5, you should look into government and corporate bonds. Bonds are debt securities issued by governments or corporations. When you buy a bond, you're essentially lending money and earning interest in return. They are generally considered safer than stocks, but may offer lower returns. Number 6, let's look at my favorite investment, which is real estate. Investing in real estate, either through purchasing property or real estate investment trusts, REITs, can provide rental income and potential property value appreciation. Number 7, stock market investments. Investing in stocks allows you to become a partial owner of a company and potentially benefit from its growth and dividends. However, stocks come with higher risk and volatility compared to other options. Number 8, precious metals. Investing in precious metals like gold and silver can serve as a hedge against economic uncertainty and inflation. Number 9, we have mutual funds and exchange-traded funds, also called ETFs. These are investment funds that pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other assets. They provide diversification without the need for individual stock selection. Number 10, peer-to-peer lending. Online platforms allow you to lend money directly to individuals or small businesses in exchange for interest. This can provide higher returns than traditional savings accounts, but comes with higher risk. Number 11, cryptocurrencies. While highly volatile, some people consider investing in cryptocurrencies as an alternative. Cryptocurrencies like Bitcoin and Ethereum have gained popularity as digital assets. Lastly, we have personal investments. Investing in yourself, such as education, skill development, or starting a business, can lead to potential future earnings and financial growth. The major thing you need to get out of this is, your money should always be out there making you even more money. Poor people sell their time for money, but rich people make their money work for them. You should also note that each of these alternatives comes with its own set of risks and potential rewards. Diversification is often recommended, which means spreading your funds across multiple types of investments to reduce risk. Before making any financial decisions, it's wise to do thorough research, consider your financial goals and risk tolerance. It's important to carefully assess your financial goals, risk tolerance, and the potential advantages and disadvantages of various financial instruments before deciding where to put your money. Diversification, seeking advice from financial professionals, and staying informed about the financial landscape can help you make informed decisions. I hope you enjoyed the video. Don't forget to hit that like button if you find this video helpful, and if you have any questions or suggestions, also leave them in the comments section below. Don't forget to tell me what video you'd like me to do next in the comments section below. Goodbye.